Most people will work for 40 years and never even know this moment exists, let alone experience it. There's a number that quietly determines whether someone works for the rest of their life or reaches a point where work becomes optional. It's not income. It's not net worth. It's not even how much is saved every month. It's something far more specific. And once that number becomes clear, the way money is viewed completely changes. Because most people believe they're making progress simply because their paycheck is bigger than it used to be. The apartment improves, the car gets newer, life looks upgraded on the surface. But underneath all of that, something hasn't changed at all. Everything still depends on working. Income comes in, expenses go out, and the cycle repeats. That's the silent trap. It feels like progress, but it's actually just movement without direction. Because if income stops, everything stops. There's no system running in the background, no engine producing income independently, no momentum, just effort. And that's why most people, even after decades of working, never reach the moment where their money starts working harder than they do. That moment has a name. It's called the crossover point. And it's the point where investment income finally surpasses salary. Not in theory, not someday, mathematically. It's the moment when the money being generated by investments every year becomes greater than the money earned from a job. At that point, something fundamental changes. Work becomes optional, not because of luck, not because of some viral money hack, but because of a simple equation that finally flips. Investment income becomes greater than expenses. That's it. That's the entire game. And yet, most people never even realize this moment exists, let alone plan for it. Instead, the focus stays locked on income, promotions, raises, side hustles, all of it built around increasing active effort. But income grows in a straight line. Capital grows differently. Capital compounds. That means it starts slow, almost invisible, and then over time, it accelerates in a way that feels almost unfair, but only if it's actually being built. And this is where things usually go wrong. Because increasing income alone doesn't solve the problem. In fact, it often makes it worse. Take a simple example. Someone earning $60,000 a year, spending $55,000, saving $5,000. That sounds responsible. It sounds like progress. But after 10 years, that's only $50,000 saved. And when inflation is factored in, the real value is even lower. Meanwhile, housing costs rise, services get more expensive, life continues to expand around that income. So even though more money is being earned, nothing really changes. Still dependent, still tied to working. It's like running on a treadmill where the speed keeps increasing just enough to cancel out any forward movement. More effort, same position. Now compare that to someone with the exact same income but a different structure. Instead of saving whatever is left over, 20% is automatically invested before anything else happens. Spending adjusts to what remains. Over time, that creates something completely different. Not just savings, but assets. And assets produce income. At first, that income is small, almost irrelevant. A few $1,000s a year. Not enough to live on. Not even close. But something important has changed. There are now two income streams, one from work and one from capital. And that second stream doesn't require time. It doesn't require effort. It just requires consistency. This is where the crossover point begins. Because it's not a single moment that appears out of nowhere. It's something that builds quietly over time. At first, investment income might only cover 5% of expenses, then 10, then 20. At 25%, something interesting happens. There's flexibility. At 50%, there's real freedom. At 75%, work becomes optional in practice, even if not fully replaced. And then, eventually, the lines cross. Investment income becomes greater than expenses. And that's the crossover point. The moment where salary is no longer required to sustain life. Now here's where the math comes in. Because this isn't abstract, it's very specific. Take annual expenses. Let's say that number is $60,000. The question becomes simple. How much capital is needed to generate $60,000 per year? Using the 4% rule, which is based on decades of market data, a portfolio can safely produce about 4% of its value annually. So 60,000 divided by 0.04 equals $1.5 million. That's the crossover number. That's the portfolio size where investment income can replace a $60,000 lifestyle. And this is where most people hesitate, because 1.5 million sounds distant, almost unrealistic, especially for someone starting with a modest portfolio. But this is where the timeline changes everything, because reaching that number isn't about sudden jumps, it's about compounding. For example, investing $1,000 per month at an average return of 8%. At first, progress feels slow. After 5 years, the portfolio might reach around $70,000 to $80,000. After 10 years, it could be around $180,000, still far from the target. But something important is happening beneath the surface. The base is growing, and once that base gets large enough, returns begin to accelerate. At around $300,000, annual returns might be generating $24,000. At $500,000, that number jumps to around $40,000. Now the growth starts to feel real, because the portfolio is doing more work than the contributions. And then comes the turning point. At around $800,000, investment returns can reach roughly $60,000 annually. And suddenly the income from investments matches the income from work. That's the crossover point in action. And for someone starting at age 25, investing $1,000 per month, that moment often arrives around age 49. Roughly 24 years start at 30 and it shifts to around 54. Every year of delay pushes the timeline forward, not because the math changes, but because time is the most important variable in compounding. Now here's where it gets even more interesting. Because the crossover point doesn't just depend on how much is earned, it depends equally on how much is spent. Lower expenses don't just reduce lifestyle costs, they reduce the size of the target. For example, cutting $200 per month in expenses reduces annual spending by $2,400. That means the required portfolio drops as well, and at the same time, more money can be invested. So the timeline shortens from both directions. The target gets smaller and the contributions get larger. That's why the crossover point is so powerful. It responds to both sides of the equation. Earn more and invest the difference. Spend less and invest the difference. Both accelerate progress, but combining them creates exponential impact. Now there's another layer most people don't consider: taxes. Because income from a job is taxed differently than investment income. A $60,000 salary might result in around $48,000 after taxes, but $60,000 from long-term investments might be taxed closer to 15%, leaving around $51,000. Which means, in real terms, investment income can surpass job income even earlier than expected. Now, of course, this doesn't mean the moment the numbers match, everything stops, because markets don't move in straight lines. A portfolio worth $800,000 can drop to $560,000 during a downturn, and the income generated drops with it. That's why most people don't stop at the exact crossover point. They build a buffer, 1.5 times or even 2 times their required income. That way, even during downturns, the system holds. Because the goal isn't just reaching the crossover point, it's sustaining it. Now here's something that changes how this entire process feels. In the early years, progress is driven by contributions. $12,000 per year invested might generate $2,000 in returns. But later, the situation reverses. At $500,000, that same portfolio might generate $40,000 per year in returns, without any additional effort. That's the moment where the system becomes self-sustaining, where capital begins to outpace labor. And once that happens, the gap closes faster than expected, because every dollar invested isn't just sitting there. It's working, constantly, every hour, every day. And over time, those dollars begin to multiply. 1 becomes 2. 2 becomes 4. 4 becomes 8. Not instantly, but inevitably. And this is where the psychological shift happens. Because before the crossover point, work feels necessary. After it, work becomes a choice. And that changes everything. Decisions are no longer based on survival. They're based on preference. Opportunities that were previously too risky become possible. Environments that were tolerated become optional. Because the dependency is gone. And that's the real value of the crossover point. Not just money, but control. Now the reason most people never reach this point isn't a lack of discipline. It's a lack of structure. Because saving after spending doesn't work consistently. Lifestyle expands to fill income, and whatever is left remains small. That's why the system matters more than motivation. Pre-allocating a fixed percentage, automating investments, reinvesting all returns, and tracking the relationship between investment income and expenses. Not just net worth, not just salary, but the one metric that actually matters. How much income is being generated by capital, compared to how much is needed to live? Because that's the line that eventually crosses, and when it does, everything changes. Once the crossover point starts getting closer, something subtle begins to happen. The focus shifts. At the beginning, the question is always, how much is being earned? Later, it becomes, how much is being generated without effort? That shift is everything. Because income from work has a ceiling. There are only so many hours in a day, only so much energy, only so many years available to trade time for money. But capital doesn't have that limitation. It doesn't get tired. It doesn't need breaks. It doesn't negotiate salary. It compounds, and once it reaches a certain size, it begins to outpace anything that can be earned manually. That's why two people with identical salaries can end up in completely different positions over time. One increases income, upgrades lifestyle, saves occasionally, and remains dependent. The other builds capital deliberately, even if the income is the same. After 20 years, the difference isn't small, it's massive. One might have a small amount saved, barely producing anything. The other might have hundreds of thousands invested, generating tens of thousands per year. Share this with someone who needs to see it, and stay connected for more content that simplifies complex financial ideas into something actionable. Because understanding the system is the first step. Executing it is what changes everything.